One. Boom, and we're live. All right, guys, welcome to Wolf. Happy Friday. It's great to see everyone here. Today we're joined by Paul Marino, Chief Revenue Officer at Leverage Shares from Themes ETFs. Paul has been at the forefront of bringing innovative ETFs to the market, bringing investors success, hopefully, and hopefully learning more about the market as well, but also understanding different ways to get yourself in the market to hopefully make yourself a little bit more extra bread over these years and learn more and more about the finance world and see whatever the opportunities there are in the market. So, Paul, thank you so much for joining me. Would love to jump into the conversation, get a little bit more on you and yourself, how you found yourself in this role here. And then I definitely want to get some of your thoughts on the recent market sentiment shifts as well. So if you could, just a brief introduction on yourself and Leverage Shares as well.
Great. Kate, thanks to have me on. Really appreciate it and love what Wolf's doing overall. So a little bit about me, and I'll keep it brief. I've been in the asset management space for over 25 years, started on the mutual fund side way back when. But as the shift went to ETFs, the writing was on the wall that the ETF wrapper was so innovative and it was going to change the landscape of how we look at investments and how people can access asset classes. And so, it was always something that I wanted to make the transition to, and I was fortunate enough to do that a few years back. I've always been on the distribution side, leading and running and building sales teams, even at some of those larger asset managers that I worked for. So the transition over to the ETF space was just very simple for me and also liberating because it's a little bit of a different market. We do things differently. It's not just about marketing and distributing to advisors, but also to the retail community that can easily access us on exchanges. So how I got to Leverage Shares, I was at a prior shop that was doing something similar, and this opportunity came up at Themes ETFs and Leverage Shares by Themes, which is our US brand. First and foremost, our CEO is a killer in the space. He comes from a large shop that he was a founder of, for many years. That did very well. When a deal was made and he decided to leave, he always had it in his head that he could do it better and build something in the US and in Europe, not only that gave you the proper exposure for what you were looking for, but also could do it at a more affordable price, because we still believe at Themes ETFs and Leverage Shares by Themes that expenses do matter. And so him and I had a conversation. He told me what he was building, and it was very easy for me to come on board and help him build out distribution, marketing, sales, business development, so on and so forth. And I'm happy to share that when we started this mission not too long ago, we started it, from zero, and today we're approaching 650 million in AUM very, very quickly. Within the course of the last year is how we built those assets. And we just see the trajectory continue to grow. And I think it's because what we're offering is something innovative and differentiated. We're not trying to be, one of those big, broad ETF players. We're really focused on high conviction investments for people who want access to certain asset classes or institutional type investments that, maybe aren't expert at getting that on their own. We're providing that for them in an ETF wrapper at a very low expense ratio.
Yeah, and I want to get into this because, that's amazing to hear. And there's also a couple other announcements I'd seen that I wanted to inquire on as well for a couple other things you guys have. But I would like to parse apart a little bit the ETF world. So like you mentioned, you came from a different world, and then you mentioned jumping into the ETF world. So I'm sure for some people, they're like, I don't even know what that means. I thought that was all just the finance world. Could you dive into a little bit the differences of the two worlds? And also maybe misconceptions people have about ETFs, because you're right. A lot of people think ETFs, it's the boring thing. You buy all the things. It goes up like, a tiny bit, I think. I don't know. I just throw it in there and hopefully it goes up over time. A lot of people think about ETFs like that, I've found.
Yeah, mutual funds were great. That's the world that I started in. And, they served their purpose, and it was an excellent investment vehicle for people to pool their assets so they can get access to certain asset classes. But they had problems. They were expensive. They had built-in fees. They had all this kind of revenue sharing that people didn't know about. And so, you're seeing a better vehicle in the ETF because it strips out all those fees. They're exchange traded funds, right? So you can get them on an exchange. So everybody has access to them. Again, generally they're lower fee. And they are so flexible that what you're seeing is, people say to me all the time, what's the most innovative ETF out there? And I said, it doesn't matter. The most innovative thing is the wrapper, because it allows you to gain access to any type of investment. So what you're seeing now is a shift from these broad index ETFs that were just capturing the market to very specific high conviction strategies. In our case, we're doing 2 times leveraged ETFs. So we're affording investors who may not have the experience in getting leverage, or are nervous about pricing options or structuring options, or are nervous about margin calls on the short side. We're offering them institutional-like exposure to leverage that they hadn't had before. We're also giving them, high conviction offerings in the highest growth spaces in the world, right? So what we're hearing from investors is, I've been in all these mutual funds for a long period of time, or my advisors have been, just giving me broad indexes, but I feel like I'm missing a component to my overall asset allocation and where I want to be. So with Themes ETFs on a thematic and sector-based side, we offer you high conviction exposure to things like AI, Chinese AI, global defense with our NATO strategy, which literally is comprised of defense companies inside of NATO member countries, including the US, right? So when you think about that, right, that fund in and of itself is up plus 40% year to date. Why? Because spending on NATO is increasing, and there's a mandate to take that from 2% to 5%. If you didn't have an ETF that gave you that kind of high conviction, you wouldn't be able to access that market. You might get a couple of defense strategies that are inside of broader portfolios, but you wouldn't be able to capture that growth. What we see is a shift from just these plain vanilla, overly diversified strategies that were basically, in a mutual fund form. And we're seeing that innovation with the ETF wrapper to give you higher conviction exposure, which we think will benefit investors over the long haul.
That's a very fascinating way that's probably the most eloquent way I've heard anyone talk about ETFs. So this is fascinating. I'd love to kind of inquire on the current macroeconomic environment, I guess. And, on the ETF side, as well as on the non-ETF side, just get a bit of a pulse check on your side, how you're feeling about things, how you're viewing things. And then, I guess how you guys are planning to continue to attack the markets, as well as putting out different options for people and investors for the rest of 2025 going into 2026.
Yeah, I think I'm bullish on the rest of 2025 and the next few years. Let's put it this way. We have some issues, right? Everybody has some issues. We're getting close to $37 trillion in debt. For whatever it's worth, we have a Federal Reserve System that makes certain decisions at times that impact the market. I think, the media is both good and bad. It offers transparency, but it also provides confusion, because people hear, oh, rates are going down. I won't sell my house today because interest rates will go down and the price of my house will go up. But that's not necessarily how it works. And in fact, what we may see is the Fed lower interest rates and the short end will go down, but the long end might go up. And so while transparency is great, it offers what I would consider a lot more volatility. But I think volatility could be your friend. All right. What used to be put it in the broader markets, we have the Fed behind us. We have monetary policy behind us. Like, just let it ride is no longer the case. Like, broad markets will work to a certain extent, and we think the averages will go up, especially going into the end of 2025 and beyond. But we also believe that investors need exposure in certain places that offer them a better risk reward opportunity moving forward. And I think what you should do with that transparency, what you should do with all that research, is find those pockets that you have the highest conviction and play the volatility to your advantage. It used to be just buy and hold, right?
Yeah.
And to a certain extent, you could still do that. But what we're finding is the best return streams are coming in certain categories that they hadn't before and are most volatile, right? So we've been trained to diversify and overly broaden our strategies so that we can mitigate, they would say mitigate risk, but what they were really trying to do is mitigate volatility, make people stay invested in the market. I think moving forward, we have to re-educate the investor to say, volatility could be your friend. Because if you have high conviction in an investment, you could double down into that investment. You could dollar cost average into that investment and take advantage of the volatility if you believe things are moving forward. So we are bullish on certain sectors. We think the largest financial institutions are going to prevail because they are built, they have the scale, they have the deposits, they are integrated, they are less interest rate sensitive. So whatever happens with the Fed, we think the largest financial institutions in the world, the GSIBs, the globally systemically important banks, are a place where people should look. We think they're going to do better than a lot of the other financial institutions that have exposure in places that could harm them depending upon how the Fed moves or what the debt does to us. We also think they're investing in some of the major components of high growth areas in the economy, whether that's AI, clean energy build out with nuclear, or like I said, global defense. I mean, again, I'll jump back to global defense for 1 minute just because it's, to me, such a no-brainer. And if you have high conviction, you have to think about these things. When the NATO member countries tell you we're going to spend on our own defense, when Germany decides to actually take on debt to spend on their own defense, and when you have all of these geopolitical risks, including the major one, which is Russia and Ukraine, which hasn't been resolved yet, and NATO says, we're making a commitment, NATO countries say we're making a commitment to raise the investment in our own defense from 2% to 5% over the next 10 years. That tells you that the path to spending on defense is there. How do you capture it? Whether or not you have some big dips, I get asked all the time because we have a portfolio that has both European defense companies and US defense companies. And people say to me all the time, which one's better? And I say, we don't have to pick. Like, they're both great. Because when you look at it, the US companies are, they have the highest and best technology. They're the most advanced, the best ammunition, the best air defense systems, the best drones, right? So Europe has to invest there. But they also know that in order for them to be self-sufficient, they have to invest in their own company. So what you're seeing is a rising tide lifting all boats, right? That's what you want to do as an investor looking forward. Find the pockets, okay, where you think there's high conviction to grow, and then make an investment case and go there. And I think if investors do that, you could start to pick pockets of themes or sectors that are going to do really well for you. And from the themes ETF side and the leverage shares by theme side, we are trying to offer products for people to absolutely do that 100%. Find that high conviction place where you want to be and complement your existing diversified portfolio with those places. And it's resonating very well with the retail community and also with the advisor community.
I love that. And you spoke about a few different things. So I kind of want to inquire on how exactly you guys think about and do the balancing side of things. You mentioned liquidity, diversification, and the different ways you guys are able to sort of mitigate for various risks. And we had brought up right before the show, we brought up maybe potentially bringing up Bitcoin and crypto. Obviously a bit more volatile than some of the other markets. We've seen Bitcoin really break away all the way up until literally like 2 months ago. We see Tom Lee come out to really start to get loud about Ethereum. And obviously his company starts buying, Ethereum starts to run, crypto's right back into the game, and now everyone's talking about it again. So we're starting to see treasury companies pop up, but they're buying altcoins instead of just Bitcoin. And so the whole conversation is all out the door. We've had conversations at Wolf Bitcoin. We're like, hey, do these companies know that they're buying assets that some of these we're not sure about? We've got Bitcoin over here, but these other ones we're not sure the direction of this. So we've seen a bit of chaos on that side of things, but just want to get some overall thoughts from your side on Bitcoin and the industry overall. We got stable coins, of course, coming that a lot of the traditional finance folks have also been paying attention to a lot.
Yeah, so let's just talk about Bitcoin first because it's very different from the others because it's going to have limited capacity. Like, it's finite, right? So when you think about assets and you think about all the bubbles that have happened in the past, those assets were not finite. This is a finite asset class that has high demand, and the demand is growing, and the demand hasn't even really begun because institutions haven't really dove in, but they're starting to dive in. Governments haven't really dove in, but they're starting to dive in. So when you think about limited capacity, a finite amount, and then you think about all the investment that's coming in, we think Bitcoin is a little bit differentiated than some of the other crypto plays. And again, yes, you're going to have volatility. Why? Because whenever you have giant moves up, there are always people that were in it very early on that are going to want to take profits. And that's okay. And it's also going to be for liquidity purposes and various different things. You'll see that volatility. But if you've noticed, no matter what the volatility is, it's still one of the best, if not the best, performing asset class since its inception. So what does that tell you? That tells you if you have high conviction in Bitcoin, the way that I have high conviction, thinking it's, whether you want to call it digital gold, I think it's better than digital gold because they're still finding gold and mining gold all over the place.
It's true. That is very true.
That Bitcoin has, right? It's got utility, it's digital, it's portable. Like I always used to say to people back in the 2008 crisis, people would say to me, I'm loading up on gold bars. And I would say, well, you better load up on guns too. Because if somebody finds out you got those gold bars, they're coming for you. And by the way, they won't even be able to move them. Like, what are you going to do? Sit by the Heathrow Airport, by your vault, and start, picking off pieces of gold? Bitcoin is so much different. So I think that's something where you put up with the volatility. And if you believe in it, you have to think that that's going to be a store of value over time that is quite different from anything else. And I always encourage with Bitcoin to go back and read the Satoshi white paper. Because when you read the Satoshi white paper, you realize why it exists and why it has caught on. It's new money. It's a new store of wealth. And I think people have to start to think about that differently. When you talk about Ethereum, okay, that's a little bit different. There's so much utility in Ethereum, and there's so many things that are being built on the Ethereum platform. So while I believe that there's also a case for Ethereum, Solana, and some of the others, like it's very different from Bitcoin. Bitcoin to me, even with volatility, is a little bit of a safer play. I have super high conviction with that. And I think with some of the other crypto plays, I'm always looking at, like how to play them, what the best way to do that is. And again, a lot more volatility, so you have to be able to stomach it. But I think what's happening with BMNR, with Tom, like I think all that stuff is amazing. And I think there's going to be, I think we're just at the beginning stages of that. Whether you want to talk about the gold rush or whether you want to talk about, oil back in the day, if you're making solid investments across the board, and I think the reason why people just don't stick with one, think of it as an options play, right? Why do you play options, or why do you generate options for your business? Like, what if Themes ETFs and leverage shares said we're going to come out with one ETF, that's it, we're all in on this? No, because we've got to build multiple revenue streams, so we build multiple options within our organization to make sure that we're both being attractive to investors, giving them what they want, and then and have the ability to attract AUM. That's what I think these different crypto plays do. And so it doesn't mean if you and by the way, with some of these altcoins, you could get a lot of altcoins very, very cheaply. Like it doesn't cost a lot of money to get a lot of altcoins. So all that has to happen is you play your options. I would, from my perspective, I think Bitcoin is the real deal. I think Ethereum and Solana follow that up. You play some altcoins, and then, if one of them takes off, it's almost like you're an angel investor, right? Angel investors take on multiple opportunities, and then all that has to happen is one or two of them really takes off, and you do well for yourself. So that's the way I kind of think about the cryptocurrency. I think it's very, very early stage. There's going to be lots of volatility, but I could tell you as a dad who has a son in business school, I keep telling him, learn everything you can about crypto, about blockchain, and about that moving forward, because that's going to be your financial future. And the people who master that are really going to do well.
Wow. Especially that last sentence there. This is what people are going to be using, especially the kids growing up with Robinhood on their cell phone when they're, 17 years old. They can't wait to get their first Tesla stock or, their first whatever it is. They're excited for it. And just to double click on the Bitcoin thing, I didn't know your thoughts on it. And that is the coolest thing to hear. It's so nice to hear, actually, from someone coming from the traditional finance side, to be like, okay, wow, they read the white paper. They understand why Bitcoin came. Do you think the difference in, do you think the traditional finance side not fully accepting Bitcoin, is it purely just on, do you think that they haven't done the research? Do you think they understand it? They just reject it entirely? What do you think the main reason is for the people who are not on board? Because your conviction is stronger than I've seen in a lot of Bitcoiners even.
Well, here's why my conviction is strong. I saw this meme on Instagram, but it's very true. 15 years ago, it might have cost you 100 or 100,000 Bitcoin, or even more, maybe 1 million Bitcoin to buy your dream home. Today, most people could buy their dream home for about 5 or 6 Bitcoin. Think about that. Think about what it's done to your purchasing power. Okay. And then think about what you hear outside of everywhere else. Like purchasing power is a problem. Okay. But the financial institutions are ingrained in the Federal Reserve System. They built it, right? So it benefits them. Like, when people say buying a home is the American dream, no, buying a home offers you security. It offers you a place where you think you own. I'm going to put quote unquote think you own, because you actually don't really own it, right? You don't pay your tax bill one month, it's gone, right? So my point is, that was the bank's dream. The banks needed to lend money and charge interest rates so that they can make money. And then even when, former Federal Reserve Chairman Ben Bernanke came out and told people everybody should go refinance their loan. Why? All that did was re-amortize loans so that the banks could collect more interest up front and make more money, in my opinion. Like, if you could afford your mortgage, you should have just kept paying it down and paying into the equity of it so that you can build equity, right? But people don't realize this stuff. They just listen to what they say. So my point is, how are you going to increase your purchasing power? And when I think about Bitcoin, I think of that as a place where you can increase your purchasing power over time. Again, because it's finite. When we went off the gold standard, that changed everything. And so the reason why I'm so convinced about that, and the reason why I have high conviction, is because of that. And I mean, we're building products today for investors to get exposure to the companies that we think are going to benefit from crypto and Bitcoin. And so, again, it's you could go to the TV to find out if it's going to rain, or you could stick your head out the window sometimes, right? And opinions are opinions. Everybody's got one and everybody's concerned. And I think when it came to the banks, Bitcoin didn't benefit them. So they go out and they talk their book and they try to resist the change because they're not ready for it. And they haven't built the infrastructure to do that. And they're worried about their own business. And I don't blame them. They have to be. But I think the people who are quick to adopt, the people that were quick to innovate, and now the people that are transitioning quickly, they're the ones that are going to win. And you're going to see a paradigm shift. Look, JP Morgan wasn't always the largest bank in the world. They are today because Jamie Dimon did things differently when he took the helm. That's okay. They're also, when you go in and when you have some free time, Google all the banks that have gone out of business. There's more that have gone out of business than you think. And most of the times it's because they didn't build in options and they didn't adapt, right? The world is very different today than it was 50 years ago. And the world will be very different today, 50 years from now, than it is today. And what I'm looking to do, like I said, for my kids and for anybody that I give advice to, and even for myself, is try to figure out where that's headed, be patient, stomach the volatility. If you have high conviction, stick there. And I think the reason why the banks and the Federal Reserve System and everybody else resisted is because they didn't know how to take advantage of it, and they were nervous about the volatility.
Wow. Man, I think that was very well put. I think you're right. I think if people did the research, there was someone who came on and we were at that conversation. I think we were talking about the 08 crisis, but they were like, hey, 2008 was not that long ago. They're like, you guys think it was way in the past. It was a few years ago. And they're like, and by the way, we got off the gold standard not that long ago either, within a lifetime. He goes, so just so you know, the timeline here is just so we're not out of context here. It was a fascinating conversation. I've heard a lot of people, including Ray Dalio, come on. He's talking about, hey, rebalancing portfolios. He's like, hey, maybe consider adding some anti-money in there, some gold, some Bitcoin. What are your thoughts on gold's performance this year? How it's performing end of year 2026 and beyond? What are your thoughts? I imagine it's potentially similar with the Bitcoin arguments, but
yeah, I mean, I prefer Bitcoin just personally, but I think gold is, there's two different generations, and some generations are not going to dive all into crypto and Bitcoin. Others are going to go to gold, and it's a safe haven. It's still a safe haven. It will always be a safe haven, and it's been undervalued for quite some time now. So I'm bullish on gold too, because anything that could store value differently than this, I'm blanking on, oh my God, I'm blanking on the world, but on the monetary system that we have today, right? I think is great. And so I think there's a place for gold in your portfolio. I think there's an even better place for gold miners if you really want to ramp up returns, because Gold miners are going to, if you think about spot gold, it goes up and down, but gold miners are profitable above 1,300 an ounce. We're way above 1,300 an ounce. So gold miners have been doing very, very well for a long period of time, and the performance looks really, really great. But yeah, very positive on gold and anything that is a store of value that can, help store that value outside of what your dollar is doing. Again, if you go back and you think about that 2008 period, there's another hedge fund manager that doesn't speak a lot, but I got to read an excerpt of what he said at Harvard Business School, a speech he gave at Harvard Business School in 2011. His name's Seth Klarman with Baupost. And what he said was the problem with 2008, 2009 and the aftermath is that we never learned a lesson. After the Great Depression, it created the Depression era mentality. And it changed the way people lived their lives, saved, invested, so on and so forth. Right. And that grew out to be the value investing style, Graham and Dodd, Warren Buffett, and people did very, very well during that period of time because they realized times had changed and you had to think about things differently. After 2008 crisis, people went right back to the same old tricks.
Yeah.
Like we are still printing money like crazy. We're still borrowing money like crazy. We're still deficit spending like crazy. The value of the dollar has lost so much. Like your house didn't go up in value. Your dollar went down in value, right? And again, if you use the comparison to Bitcoin, your Bitcoin has just gotten stronger, right? So where do you want to put money? Gold has gotten stronger. Where do you want to put your assets? In something that is growing and gaining value, or something that continues to lose value? And so that's the things that we're struggling with right now. And I think as we get over security issues, as we get over, the volatility issues, more and more people will start to realize, like, you know what? I'm tired of losing value in the things that I own. I want to gain value in the things that I own. And I think Bitcoin offers that. Plus, it's more liquid. Like, You think about it, you could say, well, put your money in real estate because that's gone up, in quote unquote value, but it's not as liquid as it is. Talk to a realtor over the past 2 or 3 years. See how they've been doing. See how they've been able to move. And also talk to homeowners that have bought in 2019 and can't sell for that same amount. Like they have to go back, if they want to sell their property, they're being offered a lot less and they have to write a check at the closing. See how well that looks. Like they don't like that. So I just think that gold is another place where you could put money and you could store that value and grow that value much better than some other assets out there.
Yeah, agreed. Oh, I want to get some of your thoughts on this as well. You guys had slightly different subjects, but 2x long UNH daily ETF, casually just doing okay, I guess you could put it. So I would love for you to tell us a little bit about this. You guys crossed crazy numbers, 100 million in AUM. This is very recent. I believe it was
more than 100 million.
The last month or two, right? Like very recent.
100 million. I didn't look at the number this morning, but we're over 200 million.
Oh, nice. Okay, so yeah, that was going to say that was a few weeks ago. So I was going to get an update from you. So we're over 200 million AUM in this then.
Mm-hmm. Yeah.
Man, okay, tell me more about this.
Well, I think a lot of this stuff could be timing, right? So when you think about what happened with UNH, it's the largest healthcare provider in the U.S., I believe, in the world. And then back in December, there's a tragic event that happens on the streets of New York City. Never should have happened. Awful event. But at the time, the stock was trading at, I believe, 610. And then it started to go down. And then it got down to a place of like 230 just recently when we launched the fund. But what you found out when you listened to their earnings calls is there was a transition in place. They hired their former CEO to come back that was, responsible for a lot of that growth. They changed their CFO, and they had 51 million subscribers. Think about what you could do with 51 million subscribers, right? Like Wolf Financial had 51 million subscribers. Think of the reach you would have. Yeah. So, and that's very sticky because it's, a lot of that is membership through corporations. You don't change your healthcare provider overnight. And they were building out programs that were very innovative within the healthcare system that were changing the way that they looked and paid on healthcare, addressing their problems. And then also, and this is like almost like a telltale sign, when the government comes after you and files a lawsuit against you, it's almost like you can't get any worse than that and you have to build back up. And I think what happened was, a lot of the noise was causing investors, fear and greed, right? Nobody was greedy. Everybody was fearful, selling out of the stock. Hey, this thing's going to the basement. But when you looked at the base case of their business was okay. And their revenues were outstanding. And they weren't falling off a cliff. And so they just hit a price level where people started to become interested in it again. And our timing was perfect. And people wanted to jump on board and get exposure to UNH. They saw that we launched UNHG, which was a 2-time levered to the upside UNH. And so, we caught fire and we caught it very quickly. And then, we already mentioned him today, but Mr. Buffett came in and he started buying the shares and that got announced. Yeah. And I think, price levels do matter. And stocks will go down much further than you think. It lost more than 60% of its value, still with a very solid business moving forward. And, people are interested in the name again. And when we think about product innovation, we talk about, not just where the stock is trading today, but where to be trading tomorrow. And it became a very interesting name. We were compelled to launch the strategy, and we're very happy that we did.
Yeah, it is the craziest story. And condolences, of course, with everything that happened. And then congratulations on the play there, because I remember it was am I really going to forget the movie name? It's so famous. Everyone talks about The Big Short, I think it was. And it's the one where, everything's crashing. They're all looking at the TVs and they're all like, the market's not crashing. And they're like, oh my God. And then you start to see them like, the market hasn't crashed. This is our chance right now. And that I just remember seeing that movie and I was like, whoa, it depends how you see the world. But that was fascinating to me because that's how it is behind the scenes. And unfortunately for people who saw that scene, they were like, are you kidding me? And they get mad. I'm like, listen, I don't know what to tell you. This is kind of the world we're in. This is sort of how it is behind the scenes. And this just, it is what it is. And that ended up, what led to the entire crisis, which led to, like you said, the whole mentality shift with actually, I know, I'm not sure how much you want to go into this, but if you could speak a little bit more onto, I guess the mentality you mentioned of the post-depression, and then what you see maybe happening now, we're in this world where we're sort of just getting used to just endless debt and just being able to constantly not have to learn our lessons, just do whatever we want. What do you see the ramifications for that in the mid to long term, maybe?
Yeah, I mean, the fiscal policy was much different back then, and there was a gold standard. And, that's the reason why we got off it, was because we thought, if we could print money, we could get our way out of any kind of debt. And, that's a problem. And so when you look at it today, we're $37 trillion in debt. Our entitlements that we have to pay out are way more than that, up in the hundreds of trillions. And I don't think anybody even understands what $1 trillion is. I really don't think they understand it. So I was looking at something the other day when we were talking about gold. I think we have 1.3 million ounces of gold at Fort Knox. We have another 1.3 million ounces of gold outside of Fort Knox, but in the country. And if you take that and you times it by the ounces of gold, it comes out to about 1.5 trillion. So all the gold that we have stored is still only 1.5 trillion. We're $37 trillion in debt. So so when you think about what $1 trillion is worth and what it means in real numbers, it's astounding that we have that much debt. So during the Great Depression and after the Great Depression, the entire mentality changed. And if you look at what we're doing today, I'm my one guilty social media pleasure really is Instagram, and I'll watch all these silly memes. But it's all about the U.S. Open, the honeydew. I spent $120 on chicken fingers in Montauk, and I'm like, why are you spending $120 on a little thing of chicken finger? So we are kind of like the Roaring '20s, but with a lot more debt and really no resolution to get out of it. So we're going to have to see what happens. And if you look at the housing market and real estate, I follow that too. Inventories are going up, prices are coming down, especially in what were the hottest markets in the country, because buyers are saying, if interest rates are up, I'm not going to pay that price. So literally when interest rates were at 30-year interest rates were at 6 and change for mortgages. I'm talking about mortgage rates, 6 and change, 7 and change. The housing price was way lower than it is today. But people want 2020 prices with 2003 interest rates. That doesn't work. So eventually something has to give. We haven't run into trouble just yet because unemployment is still strong. I think the technological revolution that we're going in is sort of, helping to stem that risk right now, but it won't last forever. And I think, for me, it's about, it's not about daily returns at this point. I want daily returns, and I know that I could get daily returns, but it's about what happens when we have to pay the piper. And again, I'll go back to things like gold, go back to things like Bitcoin, Bitcoin especially. It's going to be it won't be immune because there'll be liquidity issues, right? So people will pull for liquidity, but man, it's just on a totally different system than the monetary policy. And so I think that's a place that over time will win out and increase the value of your dollar versus what's happening everywhere else.
I love the way you put that there as well at the very end. I agree. I had a crisis a few months ago where I was kind of like, okay, first time in my life I've not been month to month ever in the last year. And I was like, this is cool, but I have to reorient the way I think about investing because I've been in a trading mindset for so long, not the right way. And I need to find something to hold conviction in because otherwise I'm not going to be able to hold anything more than 10 years if I can't believe in this. That's what ended up getting me down the rabbit hole and saying, why are all these billionaires buying irrational amounts of Bitcoin? This is weird. Like, well, 70% of their net worth. What is going on?
I want to tell you something. That's the biggest issue that you said right there. And that's why people can't stem volatility is that they're month to month. And I feel bad for this generation that is always month to month because what that does to your mindset. And look, I was there when I was younger, when I was young, starting a family, the breadwinner of the household. Like you have to pay your bills and they're pretty big. But that makes you think about investing quite differently. Wouldn't it be nice if you could get to a place where you sort of humbled your lifestyle a little bit, weren't so extravagant, weren't paying for, $200 to get a reservation at Fort Charles in New York City just to spend another $600 on a hamburger. Yeah. Like we could do better than that as a society, right? We can be more humble. We don't need all those material things. And getting back to your original question is what's the difference? After the Great Depression, people stopped with the F. Scott Fitzgerald, champagne flowing parties and went back to a more humble lifestyle and built a family life that they could afford, that they could invest in. And what that did was it built the baby boomers in the next great generation. The problem is nobody's humble anymore. Yeah. Like you go online and you look at a hotel and it's like $1,500 a night and it's not even a great hotel. And you're like, who's paying this? Like who's doing this? But people are. And people continue to say, I want life experiences over, savings or this and that. And that's going to be a problem, especially where we are with interest rates rising, home values so high, asset values so high. The inflation is down, right? But it doesn't mean it went away. Those prices went up 9% for a long time, and then they stay there, and then they go up from there 2% or 2.7%. Like, why do we need to have inflation at all? If you're in something like a Bitcoin, you're not getting inflation. You're actually increasing the value of your assets. So what I would really do is just encourage this next generation to think about those high growth areas, think about how they could store their value. Don't live month to month. Yeah. Maybe live in a lesser of an apartment and buy a clunker like my dad did. My dad was born in 1937, the youngest of 9 kids. He was affected deeply by the Great Depression in the way that, and he was an immigrant, so he was impacted by all of that. And he would always say, never spend more than you can afford. Make sure you're saving something and never get caught up in what everybody else is doing. You do what you need to do for yourself and your family. That's great advice, right? And he was able to invest his first discretionary income in 1980, and he put it in all blue chip stocks. And he did very well. He reinvested the dividends, and that was a perfect time for him. And we de-risked him, thank God, because I was in the business in 2007. He was screaming at me the whole time. We did some other things, just to make sure he had risk management. And then when the market crashed, it was like, I'm glad I did that, right?
Wow.
But The only stock he held on to at that time was GE, and he was so pissed that he wouldn't get rid of that one. And I was like, get rid of that one. But he wouldn't do it. But my point is, if you have that kind of mentality, you can have a really, really good life. And again, I'll get back to it. I know he's got some extravagant things, but he's worth, a lot of money. Like Warren Buffett lives in the same house, drives the same car, doesn't live super extravagantly. And I think he's living a pretty happy life.
Yeah, absolutely. That video always kills me. He's like, man, it's like at the McDonald's drive-thru. He's like, market's down. I can't get the extra. Nah, just take a plane. And you're just like, what?
He is not paying $120 for chicken fingers at Surf Lodge.
Definitely not. That is actually hilarious. But I love that point there you're making. I think you're right. I get the sense that over the years, the more people that find out about the situation we're kind of describing here, the more they'll be like, oh, wait, what? And I think that's probably the key when people are like, well, Bitcoin's only going up because the price is up. I'm like, or they're finding out about it and more people are finding out about it and they all just agree that this thing may have a price tag attached to it. There's something that is worth these quality of assets or these quality of characteristics that is Bitcoin. It's a fascinating conversation. Got me to move everything into my net worth. I mean, a very, very large majority that I ever thought I'd have in one position.
It's a real supply and demand. Like for all these kids in college studying economics, that's real supply and demand because it's a finite amount and demand just continues to grow. So that is price movement. Like I remember when again, going back to 2008, I was talking to somebody, a very smart guy about oil. And he was saying, oh, the price is going to go up to like $250. And I was like, how? There are barges like on the East Coast that are waiting to get in. There's no supply issue. And you've said it yourself. There's 88 years of supply for oil. Like, what are we worried about it today for? Like, why is that a supply and demand issue? Bitcoin is an actual supply and demand issue. Things like uranium are actual supply and demand issue. Like, we don't have enough uranium right now to meet the needs of the build out that we want to do in nuclear, right? So when you think about another investment, like that's something that's going to grow. Like those are real supply demand issues that exist. This other stuff is like, it's the thought that there's a supply and demand issue because there's demand right now, but when demand goes away, it totally cripples the whole financial investment thesis.
Definitely. Paul, look, I feel like I probably go for another couple hours with you. I genuinely love speaking about the markets, and anytime I can get on with someone who has expertise you do, but also the passion. I didn't expect the extra bit on Bitcoin. I absolutely was so down to have that part of it. But it is very cool to kind of get your insights on that, and it's also a bit gratifying to be like, okay, there are people who are reading the white paper and fully understanding this thing, and they're not coming necessarily from this Bitcoin. What's the word I'm looking for? The cypherpunk mentality. They're coming anti-government, everything. Like there's that crowd, and you can feel it. You see their profile pictures. They got the red eyes. They're very, very in your face in that sense. And so it's cool to get a different perspective on it, and also just get your thoughts on the overall market. I was curious, just to round it out here on one bit of advice you gave, one from your father, which I thought was very powerful. So that may honestly just cancel this whole question. But if there's one thing you've learned from your times in the markets that you think may help out young investors and young traders out there who are trying to make it, and they're like, oh, look, this guy Paul Marino is chief revenue officer at a massive company. That is very cool. I'd like to be in a situation like that in a few years. What is your advice to people like that?
See it and become it, and go for it, and take the risk, and don't be afraid. I mean, that's really the only thing that I could say. So many people are afraid to fail. I was a baseball player my whole life, and I played in college, and you fail 3 out of 10 times. And I know that's cliche-ish, but it's true. You always want to come to bat the next inning and think big. Like, especially when you're young, think big, build something for yourself and think big. And if you fail, that's okay. Like do something else, like try something else. But, the thing that I would say to young people, I was probably 28 years old. It's still the biggest loss I ever had, and it happened in a day. It happened in a day. And like, it was a stock. I mean, even, I should have known this, but it was like, I was on like 2 days before it crashed. It was on like Jim Cramer, Mad Money. And he was like, buy. But I was already in it. And I was in it pretty big. And it was a company that's out of business now, but they had a phase 3 trial. And unfortunately the trial was like tainted, and man, I lost a big nut that next day. But you know what? I like looked at the screen when it happened. I took a deep breath. I sold whatever I was out of it. And I was like, what's next? So what I would say is, if you love what you do, Don't be afraid to take the risk, especially when you're young. You have a lot of time to make up for it. As long as you work hard and you're diligent and never stop, thinking about where you want to be. Like, put it out there in your mind. This is what I want to be. And then just go get there. Like, take the steps to get there. If you have an end in mind, you'll find the path. If you don't have any end in sight, you'll wander. And that's the worst thing that you could possibly do.
Paul Marino, everyone, I think that is a outstanding way to finish, and really appreciate your time. And for people who want to find out and connect with you more, and also find out about leverage shares as well, where can they go to find out more information?
So www.themesetfs.com. And when you get there, you'll see our whole suite of products, which is themes ETFs, both thematic and sector-based ETFs, our leverage shares by Themes brand, and also our new capped accelerated strategies, which are option strategies inside of an ETF wrapper designed to give you 2 times exposure to single stock securities on the upside with a cap, but only one times downside. So we keep building. We've got some products, I can't say what they are right now, but being launched next week. Again, we've got about 18 more coming out this year. So we continue to build and grow, and we're really excited about the future of investing, and we love your audience. So thanks for having us on.
Absolutely. Thanks so much for coming on, Paul. And for everyone who's watching on X, you can find out more information by clicking right in the title. Actually, I tagged leverage shares. So you can just go right there, find their website to go. Everything is right there. If you're on YouTube, the description right below us, you can find more information for leverage shares. So anyways, guys, really appreciate you coming through. Be sure to leave a like, follow leverage shares for sure, because they're going to have updates coming out, like you said. And so you're going to want to make sure you're not missing those. And we'll catch you guys all in the next Spacer stream. We'll be live again in like 13 minutes going on for the Crypto Pulse show. And we'll be on for a Bitcoin show later on in the afternoon. So catch you guys all in the next one. Take care.
Thanks, guys.